Hello and welcome to The Exchange, brought to you by the New York Stock Exchange. My name is Douglas Jonas. I'm the host today. As a reminder, today's interview is for informational purposes only. The NYSE does not recommend investments or investment strategies. I am joined today by Nick Kalivas. Now, Nick is the head of factor and core equity investing and product strategy for Invesco. Nick, thanks for joining us here today.
Douglas, it's great to be here.
So Nick, a lot of people are familiar with your Equal Weight portfolio. You have the S&P 500 Equal Weight, ticker symbol RSP. It's been around for a number of years, but you also have a more recent ETF, which is an ESG version of that S&P 500 Equal Weight, ticker symbol RSPE. Can you tell us why you decided to launch this version of the strategy?
Yeah, that's great. That's a great question. So RSP has been very, very successful in the marketplace. We've seen about $7.5 billion in flow this year. It is AUM of about 30 billion. It is really one of the largest smart beta ETFs out there. And really, given the success of RSP and what we're seeing going on in the ESG space, we thought it was worth to essentially provide investors the choice of an ESG version of the S&P 500 Equal Weight. To give you an idea of just how popular ESG is now, year to date, there's been about 13.5 billion flow into kind of broad market-based ESG ETFs, and they have about 45 billion in AUM. And so RSP is going to be a great addition to what we see in the marketplace.
Okay, so talk to us now about RSPE. What's the methodology? How are stocks actually being selected for the ETF?
Yeah, so there's a number of screens that are going on. So I'm going to keep it really high level. But first of all, you can think about companies in the S&P 500 that operate in certain kind of non-ESG friendly businesses. So they're eliminated. Then you have companies that score very poorly in terms of the UN compact. So those are eliminated. And then there's companies that are looked at that have high controversy. So they might have negative headlines, things that just aren't going well from an ESG perspective. They are eliminated. And then what you see happen is a scoring for ESG by S&P, and there's a picking of the companies, the 40% of the companies that have the highest score within the GICS industry group. Those are the ones that are selected, and then they're equally weighted.
Okay, so you gave us a lot about the process. What's the net result? How does this improve the overall ESG score of an equal weight portfolio?
Yeah, that's important to think about. And so if you look at what goes on and compare our RSPE to RSP, there's about a 45% improvement in the ESG score. And if you want to just throw some numbers on it, looking at S&P's ratings, RSP has an ESG rating of 53. RSPE has a rating of around 77. So you can see that it's got a much higher ESG rating. On top of that, the carbon intensity declines by about 15%.
So it's so interesting that you've got both versions, right? Because we can actually do a really deep dive compare between RSP and RSPE. So take us one level deeper now. What happens to actual exposures in the portfolio?
Yeah, so there's a couple of ways to really answer that question. The first is you get a lot fewer stocks. So in the equal weight version, you have about 500. In RSPE, you drop down to about 185. So there's fewer names. Second of all, equal weight by its methodology tends to tilt towards the smaller companies in the S&P 500, and it tends to have a slight value exposure to it. Those factors are still present in RSPE, but to a lesser degree. So you do have exposure to smaller stocks, you do have a value tilt, but not as much as you see in RSP. And then lastly, and maybe the easiest way to think about it, RSPE has no energy exposure, so that's a big difference. It's also underweight utilities by about 2% to RSP. And to balance that off, there's a bit more technology exposure and a bit more industrial exposure.
So one step deeper now, of course, right, is if an investor says, well, then what are the benefits, right? Well, how should they be thinking about RSPE?
Well, first of all, you're going to get that ESG exposure. So if you're conscious about ESG investing, this is a great solution for you. But maybe more importantly, it's going to really cut down on the concentration that's present in many of the ESG broad market ETFs that are present. So if you look at what's in the marketplace now, most of them are market cap weighted. And kind of if you look at some of the top 10 holdings, they range anywhere from around 25.5 to 35.5. You just don't get that in RSPE. The top holdings are around 6%. So it does not have that kind of concentration. And then on top of it, you get that small size and value tilt.
So investor and advisor, they come to you at Invesco and they say, hey, how do I use this in a portfolio? What's the answer?
Well, it's really a part of a core ESG portfolio. And so I think about it as being the anchor of a portfolio. And then you can do different thematic ESG satellites around it. So if you like clean water, if you like solar, if you like clean energy, those types of ESG strategies can be combined with RSP as kind of the core or the pillar of the portfolio.
Now, as a reminder, if you caught this episode live and you're looking for additional ETF thought leadership and great educational content, please go to our website. It is homeofetfs.com. That's homeofetfs.com, brought to you by the New York Stock Exchange, the home of ETFs, and also the home of ESG.